The first signal didn't come from equities. It came from energy markets. Oil pushed through 90, and traders immediately recognized the implication. This wasn't just a price move, it was a narrative disruption. For months, markets had grown comfortable with the idea that inflation pressures were slowly fading. But energy is different. When oil moves sharply, it doesn't just affect transportation or manufacturing, it reshapes expectations. Suddenly, portfolio managers who had been leaning into risk began asking a different question: what if inflation isn't done with us yet? Then came the second shock. The labor market, long considered the most reliable pillar of the economy, suddenly looked fragile. Payrolls didn't just slow, they contracted by 92,000. Some of that weakness could be explained away: strikes, weather disruptions, temporary distortions. But markets rarely focus on excuses. What investors saw instead was a labor market that might finally be losing momentum. And when employment weakens while energy prices rise, the macro equation becomes deeply uncomfortable. Markets rarely panic immediately. Instead, a quieter process begins. Investors start whispering about scenarios they had previously ignored. One word began circulating again: stagflation. Not as a forecast, but as a possibility. Oil climbing, growth slowing, policy constrained. It's the kind of environment where central banks lose their flexibility. And traders know that once policy options shrink, volatility tends to expand. Just as macro anxiety was building, a different stress point appeared. In private credit markets, redemption limits were introduced by a major asset manager. The move was technical, but the psychological impact was immediate. Investors began asking whether liquidity in some corners of the financial system might be thinner than it appears. When money flows easily, these structures feel stable. When uncertainty rises, they suddenly look fragile. Even the market's strongest themes showed signs of vulnerability. Reports that a major AI data center expansion in Texas might be reconsidered rippled through semiconductor stocks. The AI narrative hasn't disappeared, far from it, but crowded trades carry their own risks. When sentiment shifts, even the most convincing long-term stories can experience sudden air pockets. By the closing bell, the market wasn't simply reacting to bad news. It was recalibrating its assumptions. Oil near 100 suddenly feels less hypothetical. The labor market no longer looks invincible. And the Federal Reserve finds itself navigating a narrow path between inflation risk and slowing growth. None of this guarantees a dramatic shift tomorrow. But the mood has changed. And in markets, mood often moves capital before the data confirms the story.